The new year is nearly here, but it is not too late to get your finances in order before 2026. Better do it quick. Connell McShane sat down with financial planner Doug Flynn to share some tips on how to cash in before the ball drops.
The new year, nearly here, and we're talking to the certified financial planner, Doug Flynn, about some tips so you can cash in on before 2025 comes to a close. Of course, a regular guest all year on this program, so thank you for that, Doug.
Great to be here.
And thank you for this in advance. So let's talk through this. You came prepared with, I think, 5 or 6 tips people can look at before the end of the year, and the first has to do with our retirement savings. So let's start there. A lot of people have 401ks, but there's other ways. It could be a 403b,
sure,
whatever it is. So what should we be doing with our retirement accounts?
Yeah, well, before the end of the year, you have the opportunity, let's say you have enough money to get you through the end of the year and you don't want to pay more taxes. You can actually raise the percentage of money you're saving into your 401k. They may even let you put up to 100% of your pay into your 401k, which is a great way to shelter that money, get that in there. Of course, you want to try to max it out, but put as much as you can in there because it obviously will help you later on, and will also help you now for decreasing your taxes.
So if you haven't been maxing it out, now do it right at your last check.
You can.
Do it right at the end of the year. Get up to that level.
You can raise the percentage and you can lower it back down again in January to the normal percentage if you have enough money and you don't want to really pay any more taxes.
No, that's a good point because some people, they've thought, I'm not sure if I can, but now you get to the end of the year, so I have some extra cash.
An opportunity to do that.
To do it. The second one, define first and then explain tax loss harvest and then realize your strategic gains.
Yeah, this is open up your investment accounts. Yeah. Look inside there and see if you have any winners as well as any losers. And so what you can do is if you have some stocks that didn't do well, the last couple of years things have done well, but you might have some clunkers in there that you never cleared out. Right. This is an opportunity to get in there, sell those losers before the end of the year, book that loss for tax purposes. It does a couple things. Well, you can use it to offset some income tax, but you can also use it to offset some gains you might have in other stocks that you think, you know what, this has really run its course. I want to take some profits. Sure. Which is, no one ever went broke taking a profit. So you can offset those profits with some losses. But get in there. A lot of people don't look. They focus on the winners. They might have some clunkers in there. So clear that out and take those losses. Right.
So then you save yourself on the taxes a little bit. The other thing here, which is, hey, listen, we should be doing this all the time, but let's give some money to charity. So charitable contributions. Sounds like you're telling us to do it for the wrong reasons. I say just give money to charity because you're a good person.
Well,
you say,
the funny thing about this year is if you make those charitable contributions and you don't itemize, you're not going to get a write-off on that.
Oh, okay.
And so what you might do is, we call it bunching. You might strategically look next year in 2026, they're allowing people who don't itemize to take $1,000 of extra charitable deductions off the top, or $2,000 if you're married. So if you're going to donate right now before the end of the year and not get a write-off because you're not itemizing, do that January 1st, and now it's in next year, and now you can get maybe $1,000 or $2,000 off your taxes that you're not going to get in 2025. We want to give to charity, but if you're not going to hit those 1,000 or 2,000 numbers, maybe pushing that into early January would help you, and of course the charity gets it a week later.
Actually, yeah, okay, that's an interesting way of looking at it and doing it. What's an annual tax-free gift? What are you talking about there?
So this is when you want to gift $19,000 to Claudine or somebody else here.
Claudine's our producer. She should be giving us the money, but I see.
You're allowed legally to give up to $19,000 per person to anyone you want. There's no gift tax filing. Grandparents do this a lot. The recipient doesn't pay tax. The person who donates it to their friend or family doesn't pay tax. So it's a way to shift some assets over to people.
I think some people do misunderstand that. They say, you could give up to
19,000 this year.
Right. So sometimes they think that's lower because I guess it's gone up over.
It has. It goes up, and next year it'll be the same number. But there are people that want to give their family money for whatever, a down payment on a house, whatever it is.
For whatever reason, maybe they love their family.
Yeah, maybe.
Could be the reason.
It could be, and so you can do that. But a common question we get is this going to be taxable to me or the recipient? And it's not, as long as you stay under that annual gifting limit. And in fact, you and your spouse can give $19,000 each. So technically, you can give up to $38,000 per person if you were really feeling good.
Yeah, my wife's not giving Claudine $1, I don't think. It's like crazy here. If you're self-employed, so if you work for yourself, a lot of people do, there's all kinds of different ways, obviously, to do that in freelance work or whatever it may be. What are the things that self-employed people should be thinking about at this time?
Yeah,
maybe a little different than salaried kind of full-time employees.
Sure. So even if you're self-employed fully or you have a side hustle that you have some side income on, the rules are the same. Any of that side money can be put into a retirement account. And most people may be aware of what's called a SEP plan, and that one you can put up to a certain percentage of your money away. Yeah. But you can do it's called an individual 401k or a single 401k, and the contribution limits are much higher. The thing about this is
higher than the SEP plan, or higher
than the SEP, because you actually get also the employee 401k contribution limit on top of the SEP by doing a single K. And the thing about this is, though, you have to at least open it before the end of the year. Even if you throw $100 in it, it just gives you the ability to do more of a contribution by having that. Where if you wait until next year and your accountant says, oh, you're self-employed, you could put some money away, you're going to be capped using the SEP. So it's a way to enhance for those people who want to put a little bit more money away and save a little bit more money on tax.
No, that makes a lot of sense. It's like something for everyone in this list. Good list. Last but not least, take the required minimum distributions.
Right. So a lot of people, if they're of retirement age and they're in their 70s and they have an IRA and they're forced to take an annual distribution that's required by the government. This happens a lot with people who have IRAs all over the place. They might have a retirement plan they never rolled over. They have multiple plans, and they might lose track of one, which happens. Well, you're required to take a minimum distribution that totals the amount that they require. And if you don't do it by December 31st, of course, there's going to be taxes on the distribution. But if you don't take it, you're going to be assessed a 25% penalty by the IRS for the amount that you should have taken.
So if somebody's worked a number of jobs, like years ago, maybe you worked one job and you get the gold watch at the end, but now we're at a point in time where people have worked a handful of jobs.
Sure.
So you're right. I mean, it sounds crazy to some people. Say, well, how could you forget about all this money? But it does happen, right?
It does happen, especially if you had multiple jobs, you have multiple IRAs at different places for different reasons. It doesn't matter. And once you're 73 now or older, you're forced to take a distribution. You can take it from one of them, but you have to meet the requirement. So consolidating is probably an easier way to do this so you don't miss one. But the fact of the matter is you have to get it out and get it out soon so that you don't have that extra 25% and the taxes on top of it. So you could lose half of the distribution if you don't do that.
Yeah, if you just like a simple mistake like that, you've said, spent all this time trying to save the money. To save on the taxes, you don't want.
One other thing, if I can jump off on that.
Of course.
If you're charitably inclined also, and you don't necessarily need the money from your distribution, you're allowed to do what's called a qualified charitable distribution. And the amount you need to take for your RMD can be designated to a charity or multiple charities. That qualifies for the distribution, and now it doesn't hit your tax return, and you don't have to worry about the taxes that are on that. So it's another thing that people can do if they'd like to before the end of the year.
Very good. It's probably the busiest. Is this the busiest time for someone like you, the end of the year?
I would say the last 2 weeks of the year and the first week or so of the new year are extremely busy for us. So that's
it's a good thing.
It's like our April 15th if you were an accountant.
That's what I figured. All right, Doug Flynn, for this and for everything all year long. Thank you very much.
Again, Doug Flynn with the great tips. Thank you so much.